Good afternoon, and thank you for joining us today with our Know Your Options Navigating the DuPont and Corteva Spinoff web event. My name is Kelly Feeney, and I'm part of the Diversified team here in Wilmington, and I'll be help facilitating today's presentation. As part of my role at Diversified is to work closely with our advisors to communicate the resources we offer in our community. Our three-advisor team is comprised of dedicated, certified financial planners who work closely with individuals and organizations to help bring clarity and sometimes comfort in important life transitions. As we mentioned in our invitation, this is not a DuPont-sponsored event, and we are not affiliated with DuPont. We do work closely with employees of DuPont on an individual basis, and our hope is to help more in our community. With that being said, today's presentation will run about 45 minutes. Thank you all for joining us, and here is David Levy.
Thank you, Kelly, and hello, everyone. We're going to start off talking a little bit about the pension. Okay, so first off, this is in regards to the Heritage DuPont pension only, and what is happening to it. So as you likely already know, the pension and retiree benefit obligations, the retiree medical, dental, life insurance, all will be assumed fully by Corteva upon transition, which is June 1st. There are two important dates to keep in mind. There is November 30th, 2018. That is when the pension plan froze. So your full retirement benefit, was snapped at that time and frozen. Your pay and service accruals stopped at that time. The second date is May 31st, 2019. That is the date that you can use to accumulate your age and years of service to determine if you are retirement eligible, and if so, for a reduced or unreduced pension. We'll get into that a little bit more here in a minute. Lastly, if you are transitioning to new DuPont, you may have a possible benefit commencement opportunity. If you are going to Corteva, you will not. You will have to wait until you separate from Corteva to have an opportunity. All right, so let's talk about how the pension is protected. And first off, I want to make a note that this is not intended to scare you about the health of the pension, but rather do the opposite and provide some education and understanding of some systems and organizations and laws that are in place, to protect your interest in the pension. First off is the pension assets are held in trust, separate from the company's assets, and can only be used for pension liabilities. So those dollars can't be used or accessed for any other reason. Second is the Employee Retirement Income Security Act of 1974, also referred to as ERISA, is a federal law that protects private companies' defined contribution plans, like a 401k, or defined benefit pension plans, similar to the pension that we're speaking of today. What ERISA does is they help set guidelines and minimum funding standards for pension plans. They also require that the plan sponsor or employer share information with the participants on how it's funded and so on and so forth. Lastly, it works closely with the Pension Benefit Guaranty Corporation, also known as the PBGC. And the PBGC is also a federally run program. It is not funded through taxpayer dollars, though. How it's financed is every plan sponsor, every employer that has an ERISA-covered defined benefit pension plan is required to pay insurance premiums into into this program. So it is financed through the insurance premiums. Any plans that are underfunded, so not at 100% funding, are required to pay an additional premium into the benefit there. So insurance premiums, investment income, and/or any plan assets that the PBGC takes over is where they come up with the dollars to support that program. The PBGC will step in and continue your retirement income if the plan is terminated through what's called a distressed termination. That can be a number of things. It could be the company goes bankrupt or proves to the PBGC that they need to terminate the plan in order to stay in business, or if the pension fund runs out. So those are different areas, or different ways rather, that it could be a distressed termination. And again, the PBGC will step in and pay up to a maximum benefit. So you would get the lesser of the maximum benefit, or the benefit that you are entitled to from the plan that was terminated. And so as you can see here, that between age 58 and 65, it increases as you get older. So the benefit is based on your age, and this maximum amount is calculated annually. And for example, you could say at 58, roughly $3,200, and at 65, roughly $5,600 for the straight life annuity. Okay, so what is de-risking? Some of you may have heard of this before. So what is it? Simply, it's strategies that are designed to transfer some or all of the risk of the pension away from the employer. Why do companies do this? I think it's pretty obvious. It's in that it improves their finances, it improves their balance sheet, it'll eliminate the requirement for future contributions if need be, and simply put, it'll give them greater focus to focus on their core business and not worry about this. How do companies de-risk? So there's two ways. The first is a lump sum buyout. And this is, DuPont has already started to do this in previous years. There are plan participants that are separated from DuPont and have elected to defer their benefit and had been offered a lump sum opportunity. It's interesting to note that as of March this year, there's a new IRS rule that allows for those that are collecting an income from a pension to be offered a lump sum opportunity. Now, you cannot be forced to take the lump sum opportunity, but before March and IRS notice 2019-18, before that, if you were collecting a monthly income from your pension, you were never able to the employer was not allowed legally to offer a lump sum. So anyway, lump sum opportunity is one way that a company will begin to de-risk the plan. So let's talk pros and cons here. So for pros, you can roll these dollars into an IRA. You can now take control of the money, so you can control the investments, which would allow you to also control the timing of the income from the investments. There's inflation protection in there with the market growth opportunity. There is residual death benefit there for surviving heirs beyond spouses, possibly. And of course, it takes the dollars, it takes your interest in the pension away from the company and away from being tied to their ability to meet their obligation there. So those are some of the pros. As far as cons go, it starts with discipline. You have to now have the discipline to invest the portfolio or the dollars in your portfolio. You have to have the discipline in determining what is the appropriate amount and timing of pulling income from it. And of course, you lose the predictability and guarantee of a reliable monthly income from a pension as you know it. So that is the pros and cons of the lump sum. Second is transfer to an insurance company. And so in this case, the pension fund would be transferred to an insurance company, and the insurance company would issue an annuity that would pay you for the rest of your life or your spouse's life, depending on what option you elected. And here, the pros and cons are that the plan has to be brought to 100% funded in order for an insurance company to take over. And so that likely would mean a substantial contribution into the pension fund. So increasing the dollars that are there, increasing the health of the pension on the onset. So that is one pro. Another is insurance companies are in the business of providing insurance and providing annuities and ensuring that they can meet a lifetime income to those that are that have those products. And so it is right in line with their core business. So that's a pro. As far as the cons go, you lose the ERISA protection. So you lose the federal backing of the ERISA and the PBGC, some of the things that we talked about a moment ago. And ERISA has a stronger creditor protection. Now there is still some protections here if the insurance company were to fail to meet their obligations, but that's regulated at the state level versus the federal level. So obviously pros and cons here, but just wanted to share with you a little bit about what de-risking is. Okay, so what is your benefit commencement eligibility now? So first, again, only if transitioning to new DuPont are you possibly eligible for a benefit starting June 1st. Again, if Corteva, you have to wait until you separate from service there. So that's number one. Number two is, are you retirement eligible or not? And so in order to be retirement eligible, you have to be at least 50 years old with 15 years of service as of May 31st, 2019. So once you determine if you are retirement eligible or not, now it's down to, do you have a unreduced or reduced benefit at this time? In order to have an unreduced benefit, you either need to be at least 65 years old with 15 years of service, or be at least 58 years old plus your years of service equal 85. So that's the rule of 85 that I'm sure many of you are aware of, if not all. If you are eligible for an unreduced benefit, you would have received a packet from DuPont Connections already, and there is simply no reason to defer your payment. Your benefit will not increase over time. It is at its max at this point, again, if you have an unreduced benefit, and by deferring it any further, you are simply forfeiting dollars that can never be recouped. Okay, now on to the reduced. You may or may not make sense to collect a pension if you are on the reduced, but let's talk about how that's calculated. So every year below the 85 number, right, or unreduced formula number every year is a 5% reduction. Now that's calculated monthly, but for example, if you take a look here and you look at 56 years old, right, and 23 years of service, it's 70%, right? So your reduction is 30%. So that's 56 plus 23 is 79, is 6 years short of 85. Of course, 6 times 5 is 30%, and so that's how that's calculated. Okay, so which benefit option makes the most sense for you and your family? Now, there is simply too many factors that go into this to go over at this time, but this is a very important thing to review. With your advisor, sit down and make sure that you are determining which benefit makes the most sense for you, because this is a permanent and irrevocable decision. So once it's been made, cannot change it. Here are a couple things to keep in consideration as you think through what is best for your family. So health history, assets, income needs, marital status, survivor income needs. Those are just some of the things to be considered. As far as options go, there are a lot of options as well. They certainly don't make it very easy, but there is survivor benefit options, 50, 75%. 50% is the standard, the default if you are married, 50% survivor benefit. In fact, in order to elect something less than 50%, you must get spousal consent to sign off on that. There are joint and survivor options, which is above and beyond survivor benefit. There are certain criteria to be eligible for the joint and survivor, but if you have an unreduced benefit, you will be eligible for that as well. And they come in 10, 20, 30, 40, 50% benefits, and they don't have to be your spouse. So they can be a non-spouse. They also could be your spouse. There are income leveling options where your benefit will start higher and then reduce when you become Social Security eligible. So at age 62, your income would be reduced, structured so that you could collect Social Security at that time and keep your household income level. Again, too many things, too many options and too many considerations to get into now, but certainly something we can work with you, or you can work with your advisor to think through that. All right, I want to share with you one strategy. It is somewhat complicated, so I will try to keep this high level here, but this is what is referred to as the pension maximization strategy. And so the concept here is, how do you collect as much money while you're alive from the pension system while protecting your surviving spouse at the same time? And so if we take a look at this example, you can see option 1 is the no survivor benefit option, and in this scenario, you would get a $5,000 a month benefit, and there still is a company paid survivor benefit. So in this scenario, and this is an actual scenario here, obviously with no names, but your benefit would be $5,000, your survivor benefit would be $1,500. Option 2, and so option 1 is the one that pays you the most while you're alive. Option 2 is the option that would pay your surviving spouse the most benefit if you were to predecease them. So you can see here that's the 50% survivor benefit option with max joint and survivor. And so here you can see that you'd have to give up $600 a month to provide a benefit to your surviving spouse of approximately $3,900. So again, $600 a month is what you give up to ensure that your surviving spouse gets that additional $2,400. So the strategy here is that instead of giving $7,200 back to the company, so back to DuPont or Corteva in this example, to ensure that your surviving spouse can get an increased benefit, you can take some or all of that money and go ahead and go out into the open market and buy a life insurance policy. And so in this example, the life insurance policy, a $500,000 life insurance policy, this is based on a couple that are each 58 years old and have good health rating. The insurance would be $4,000 a year, so much less than the $7,200 you would be giving up in option 2. So you collect the $7,200 by taking option 1, you spend $4,000 of it, buy a life insurance policy for $500,000, and if you were to predecease your surviving spouse, they could dump that money into an annuity product, an immediate annuity that could generate roughly $2,300 a month. So you can see here that the income from that annuity or from that life insurance plus the survivor benefit, the company paid survivor benefit, equals approximately what you would have had through option 2. Now, the benefit of doing this is sort of having your cake and eat it too, in that you now have flexibility. One, you get to keep a couple dollars, the difference between $7,200 and $4,000, and probably even more importantly is, again, back to the permanent and irrevocable decision. If you were to select option 2 and then your spouse passes before you, well, you're stuck at that lower benefit. And if you were to do the pension maximization strategy, you could, if your spouse dies first, just cancel a life insurance, and you still have the $5,000 a month, the increase, the maximum benefit that you can get. All right, so that is pension max. So changing gears slightly, we'll talk about retiree healthcare, which works slightly different than the pension. And I want to focus just on retiree medical here, but the retiree benefits do extend to medical, dental, and life insurance, but we'll just focus on medical at this time. So also, these benefits, again, are being administered by Corteva, and in order to be eligible for these, you must have been hired prior to January 1st of 2007, which is the same as the pension, and be at least 50 years old as of November 30th, 2018, which is different than the pension, with at least 15 years of service as of May 31st, 2019, which is the same as the pension. So the only difference here is you must have been 50 years old in November and have 15 years of service at the end of this month, and to be eligible for this benefit. In order for your spouse to be covered for this retiree benefit, they must be your spouse on your last day of active employment. Similar to the pension, there is a reduction factor based on early retirement, so it works just like the pension. We could go back and look at that same grid, the 56 and 23, 56-year-old, 23-year of service example that I gave you. But in order to have an unreduced benefit for medical, you need to, again, be between ages 58 and 65 plus years of service equal 85. Otherwise, you will have a reduction in the amount that the company will contribute. Net effect to you is you will pay more for your coverage. Last thing here is you must enroll within 60 days through Corteva Connections from losing other coverage. So whether it would be your group coverage from another employer, if you're still working, whether you're still at Corteva or go to a different job, that's still your coverage there, or you're on a spouse's plan. But as soon as you lose coverage, you need to enroll with within 60 days through Corteva connections in order to get this benefit. So let's talk about retiree medical coverage pre-Medicare, so before you are 65 years old. There are two options, and they are identical to the options you have as an active employee. So you have your core option, your premium saver option. Of course, the core option has a higher premium, lower deductible, lower out-of-pocket, and premium saver has the opposite. Both of these plans are high deductible plans, so they both allow for HSAs. So even if you are retired, you can contribute to these HSAs if you're enrolled in one of these two plans. Also, if you have any deductibles or out-of-pocket expenses that you've worked towards in a year and you retire mid-year or at some portion throughout the year, those carry forward with you into retiree medical through your retiree medical coverage, so you don't lose the work that you've made towards those deductibles or out-of-pocket expenses. So that comes with you. It does not start over. Okay. Retiree medical post-Medicare. So after 65 years old. Two scenarios here. One is you are still working and you become 65 years old. You simply just stay on your current benefit, your group plan. If you are working for a company that has 20 or more employees, then you are not required to sign up for Medicare. And even if you do, your primary coverage is your group plan. So it is important to know that if you are still working, you stay on your current group plan, which is your primary coverage, and then within 3 months of your retirement date, you contact Social Security to sign up for Medicare Part A and Part B. Okay. If you are not still working and you turn 65, you should also contact Social Security 3 months prior to your 65th birthday to sign up for Part A and Part B again. Here's where the retiree benefit kicks in, is if you go through VIA, formerly known as Tower Watson's One Exchange, you will receive an HRA, a health reimbursement arrangement. And for per person that are on the plan per year, you can get up to $1,200 for medical and $200 for dental. This can cover, and again, this also works prorated for early retirement as well. But this money, the $1,200 or the $200 per person per year, you can use for Medicare supplements or Medicare Advantage plans, or simply out-of-pocket expenses, co-pays, medical expenses, medicines, whatever it may be. But it's important to remember that you must work through VIA in order to be eligible for this benefit. If you have one spouse that is Medicare eligible and one that is not, that's not a problem. The Medicare eligible individual will get the HRA, work with VIA, and the non-Medicare eligible individual will simply stay on the group retiree plan. Okay. All right. So lastly here is health savings accounts in retirement. So any balance that you've accumulated, these are your dollars to keep. It's not a use it and lose it arrangement. You get to carry these dollars forward with you. Again, I mentioned earlier that both of the pre-Medicare retiree medical plans are HSA eligible, so you can contribute to these even if you are retired. It is important to know that even if you are still working, if you enroll in Medicare, you are no longer eligible to contribute to an HSA. So example, you are still working for a company that has 20 or more employees, and you sign up for Medicare Part A, but your group coverage is still your primary, and the primary coverage is an high deductible plan, eligible for an HSA contribution, because you've enrolled in Medicare Part A, you are not eligible to contribute to the HSA. All right, so HSAs cannot be used for pre-Medicare retiree medical premiums, however, can be used to pay for Medicare premiums. So that concludes the medical, the pension and retiree medical. I'm going to turn this over to one of my partners here, Andrew Rosen, who's going to speak about the 401k, the changes there, and just the stock and executive compensation plan. So, Andrew, take it away.
Thank you very much, Dave. That was very informative. As Dave mentioned, I'm going to start with talking about the 401k or RSP plan. So at a high level, what is happening? So what's happening to the retirement savings plan if you're going to Corteva is basically nothing. It's going to convert from its current plan, just roll to Corteva. You won't miss a beat. You'll have the same fund options. It'll be the current plan you're in. You will be able to buy Corteva stock in the plan in your 401k. It'll still have open architecture, self-directed option. The only thing of note here is that you'll have a different 800 number to call Merrill Lynch for customer service. So pretty straightforward. Now, if you're going to the new DuPont, slightly different, but not a heck of a lot, is they are doing what's called a mirrored plan. It's going to look virtually identical to the current plan you are in at Dow DuPont, except it's going to be mirrored, so they actually have to open up a new plan. Because of that, there will be a blackout window from May 29th to early June here, June 10th, at which point you won't be able to make changes to your beneficiaries or investment directions, take loans out or anything of that nature. But again, you'll be able to purchase DuPont stock, and it'll have all the bells and whistles as your current plan. So let's review a couple of things about 401ks, because we're going to talk about a couple of strategies. So what do you need to know? First of all, there's a couple key contribution limits. $56,000 is the maximum amount that can be contributed into an ERISA-backed qualified retirement plan in 2019. $19,000 is the portion that you can contribute pre-tax, or if you're so inclined, you can contribute to the Roth feature. But if you're under 50, that is what you can contribute. For people that are 50 or over, and it's important to note it's the year you turn 50. So even if your birthday's, you turn 50 in the end of this year, you can still get this $6,000 catch up in addition to the $19,000 that you can contribute, and it also is tacked on to the $56,000 defined contribution limit. The other limit worth noting that'll come into relevance in a couple moments here is $280,000 is the annual compensation limit that is currently used to determine what dollars can be matched in your 401k. So at Dow DuPont, you get your 9% match, or 6% match, and 3% employer contribution, and they can't do that over $280,000 in an ERISA plan. Couple key ages worth noting. At age 59 and a half, that's when you have the ability to take withdrawals out, no penalty, so you don't get a 10% premature penalty. And also, you're able to complete an in-service withdrawal to another qualified plan. At age 70 and a half, that is when you have to take money out of your 401k or IRA. It's called your RMD, required minimum distribution. Essentially, the year at which you turn 70 and a half, there is a formula which is based off of your previous year ending total value of your IRA and 401ks, and it starts off around 3% and change as a percentage you have to take out that following calendar year. So what are your options with your 401k? So you can just do as most of you probably have done and invest in the core 13 options, 8 of which are active funds, 5 passive, and they also offer your 10 target date retirement funds. These are managed by Merrill Lynch. You can elect to go to the self-directed brokerage option. This allows you to pay a couple dollars to open up within the Merrill Lynch plan to an open architecture brokerage platform where you can select from over 2,000 mutual funds, giving you some more options. If you're 59 and a half years or over, as I previously mentioned, you can take an in-service withdrawal and you can roll it to an IRA and manage it with virtually unlimited options. And the only thing that you can't roll out is your 3% retirement savings contribution that Dow DuPont has given you. And if you leave the company, regardless of age, you can take your full account value and roll it into an IRA, penalty-free, tax-free, and you get the whole amount, not just the 3% retirement savings contribution. So this is my favorite slide that I'll talk about, which is what are the lesser known 401k strategies? There's really 3 that we've had a lot of success with our clients doing. First is the self-directed brokerage account. We talked about this previously. You can elect to open up your 401k and choose with 2,000 plus mutual funds. You also can do that and hire a financial planner such as ourselves and allow us to manage it for you. And I know that here at Diversified, we have already made Dow DuPont strategies that we allocate and for our clients that we do this with, because they rather trust us to do it than do it themselves. And we've had a lot of success with this over the past year or so with our clients. So that is an option with us or somebody else. You can do what's called the mega backdoor Roth. And quite frankly, this is my favorite financial planning strategy at all. What essentially allows you to do is, remember previously we mentioned 56,000 is the most you can put in your 401k if you're under 50. Well, a lot of you are engineers listening to this, and if you've done some simple math, you said I've contributed 19,000 pre-tax. Let's say you make $200,000. You got $9,000 from your employer. That's or 9% match, so that's $18,000. So now you're at $37,000 of contribution, and there's, quite frankly, $19,000 that you don't know how to get into your 401k. So what this allows you to do, and this is allowed on both the Dow DuPont and Corteva plan, is you can contribute after-tax dollars to your 401k for that $19,000 delta. What that then allows you to do is you can call up Merrill Lynch every year or so and say, Merrill Lynch, send that money home and convert it to a Roth. So now they send it home, convert it to Roth. We then take it, put it up into a Roth IRA for you. And now you've effectively made a $19,000 Roth IRA contribution. The beauty of this is the maximum you can contribute to a Roth in 2019 is $6,000. And if you made $200,000, you can't contribute anything to a Roth IRA. Whereas with this strategy, it allows you to contribute $19,000 legally. And I know here at Diversified, we are very big fans of Roth IRAs. They're some of the best money you can own. The final strategy is called net unrealized appreciation, or referred to as NUA. What this allows you to do is if you own your company stock in your 401k, which we have plenty of clients that date back to the 70s and 80s who have bought DuPont stock at a very low basis. And let's use an example here. And let's say they bought $10,000 worth of stock in the 70s, and now in their 401k, it's worth $100,000. And they have another $1 million in their 401k in just the traditional funds. So assuming they hit a qualified event, what they can do is they can take the $1 million of 401k normal Merrill Lynch funds and roll that to an IRA. They can then take that $100,000 of DuPont or Dow DuPont stock and transfer it in kind to a brokerage account, at which point they will have to pay ordinary income tax because it's not in a qualified retirement plan anymore. They have to pay ordinary income tax on the basis, the $10,000 that they put in immediately. The $90,000 of gain, regardless of when they sell it, will be taxed at long-term capital gains rate, which is a great strategy, and that's versus how it would have been taxed, which is ordinary income if it came out of the 401k normally. So it's a great strategy. There is a lot of nuances here, so we highly recommend talking to a professional before you do it, because there's a lot of pitfalls that would null and void this, and we would hate for that to happen to anyone. So now I'd like to turn to stock and executive compensation, as we have a lot of executive clients and this is a hot topic. So first I'd like to take a minute to just review what we all probably know, which is the merger and spin timeline. So August 2017, two of the oldest, biggest industrial chemical companies out there, Dow Chemical and DuPont, merged into a mega company, Dow DuPont, creating a $130 billion market cap company. This past April 1st, Dow spun off of Dow DuPont and became Dow Chemical again, traded under Dow in the New York Stock Exchange, also replacing Dow DuPont in the Dow Jones. And then June 1st, we're expecting everyone here that the final split or divestiture will happen, where DuPont and Corteva will become standalone companies. So what does this mean if you were a stockholder? Well, pretty simply put, if you owned Dow DuPont or Dow stock or DuPont stock prior to Dow DuPont being formed, it became Dow DuPont, regardless of which one you own. Now you own shares and got converted to Dow DuPont, and you maintain the same economic value, so your purchasing power, your value was still the same. Once Dow spun off in April 1st this year, you then received 1 share of Dow stock for every 3 of Dow DuPont, and of course the price of Dow DuPont was lowered accordingly. And then what everyone expects is in June 1st here that Dow DuPont will fail to exist again, and DuPont and Corteva will trade separately, and again they will maintain the economic value. So what if you owned RSUs and stock options? What happens? So there's really 2 camps here. There is, you received RSUs and stock options on February 15th last year, or you have received them basically any other date, whether that's before or after. So if you've received them last year, they're going to be handled by what's called the shareholder method, which essentially means as these companies turn into 3 independent companies, you will own RSUs and stock options equivalent to your pre-spin value in each of these companies. So the sum of the parts will equal the whole. So you'll have Dow DuPont stock options and RSUs. You'll have Corteva and DuPont stock options and RSUs. And that'll happen as they each spin, as you've already seen with your If you received this in 2018, you already saw that now you have Dow RSUs and options where you didn't 2 months ago. The other camp is you received them any other time, and they are being handled with what's called the employer method, which is a fancy way to say your stock options and RSUs will be converted to the company you end up working at. So the ones you received this year, if you got them in 2017, they will all come out of this thing in looking like what your future benefits will be. So you'll continually get Corteva stock options and RSUs, and your previous ones will convert into that company as well. And same with DuPont and Dow. So pretty straightforward there. The only other smaller group is the Heritage, DuPont, and Dow employees. Their stock options and RSUs, meaning because these are people that no longer have a company to go to, they no longer work for either of these entities. If you receive them in Dow and no longer are there, they will convert to Dow. If you receive them in DuPont and you are no longer there, they will convert to DuPont and Corteva. So you'll own just two in that instance. So a couple of things I'd like to talk about real quick is stock splits and reverse stock splits. So what is a stock split and a reverse stock split? Usually these are done to manipulate the underlying share price. Again, the economic value, the value of the outstanding shares doesn't really change. It's just the value per share changes. In a stock split, share price is decreased. You have more shares. Oftentimes, this is done to get a stock in line with the company, other stocks in its sector, and also make it more affordable so it doesn't cost you $1,500 to buy one share of Amazon. A reverse stock split, which is more relevant for the people in this room, will increase the stock price. Really why you see this happen is perception, and also prevents the company from being delisted from an exchange often. So you see it propped up artificially, essentially. Again, in the end, the economic value for investors does not change. So with that said, what is the big news is that Dow DuPont announced in April that the board has approved a reverse stock split, either 1 for 3 or 2 for 5. And it's going to be voted on at the end of May. Doesn't mean it has to go into effect, but they're voting on it, and so we'll see the outcome of that. But again, this is nothing to worry about. The last quick topic to touch on here is, because we get this question a lot from clients because they're kind of an esoteric thing, is the Retirement Savings Restoration Plan and the Managed Deferred Compensation Plan. So both of these are very customizable, non-qualified plans. They allow you to discriminate, whereas a ERISA-backed 401k does not allow you to discriminate. They're typically offered for executives, so level 13 or higher in the DuPont system. For the RSRP, so restoration plan attached to the retirement savings plan, essentially what this allows you to do is your income over that $280,000 limit that I referenced earlier, you're able to get still that 6% match and that 3% contribution. So why is this important and relevant? Because it prevents essentially reverse discrimination. So if you make $500,000 and you're very important to the company, you are not getting a match on your full income, whereas someone making $200,000, $100,000 is. And so this allows them not only to save above and beyond, but more importantly, get these match dollars, free dollars, company dollars in there. We're big fans of these. We usually tell our clients to get into this at very least. Um, and you can still invest in funds. It's also important to note that these are unsecured assets, unlike the ERISA plan, 401k, where these dollars are, you're basically a creditor of the company. So moving on to the managed deferred comp, this is also a deferred comp plan, a non-qualified plan. This allows you to defer up to 60% of your salary or bonus into a pre-tax into a retirement plan, much like the RSP restoration plan. And essentially, we see some people do this to get future dollars put away for retirement, and you can pick years upon separation for it to pay out and maybe subsidize your first couple years in retirement. So they're interesting plans, and again, can get confusing. So so where do we go from here? What can you do? So we recommend that you analyze your sources of income and true cash requirements. You review your overall tax planning strategies, because a lot of the stuff we talked about today refers to tax implications. You reevaluate your investment goals and timelines and your risk tolerance, and look at your emergency fund needs, because this, in times like this is where good planning really comes into play, and understanding not only your options, but the implications to it. So next steps, continue the conversation. So we created a Facebook page, a Facebook group. It's basically facebook.com/groups/lifelong advisor events. We'd love for anyone who's listening to this to join, where we can engage in conversation for the DuPont community, which is close to our heart. Also, we check us out online. We have weekly blogs. We have e-books on there. We have newsletters. We really try to provide a lot of good information, free information for our clients and prospective clients. So give us a check out there. And we are offering anyone that is interested a free complimentary financial review after today's presentation. Just email us at clientservices@Lifelong Advisors, and or feel free to give us a call and we can get you scheduled. Thank you everyone for listening, and hope you have a great day.